Our ninth lever to improve your financial position is debt management. I've been blown away at times when I've looked into companies and I discover that they're carrying a big balance on a credit card and it's carrying over month to month to month. Sometimes the entrepreneur doesn't realize that that credit card is charging them 11%, 15%, 21%, sometimes as high as 23.9%, which is mind-blowing. If you find yourself in that kind of position, strongly consider going to get either a bank loan or a loan from friends and family that's much more reasonable, maybe in the like 7 to 10% range. Then from there, use that new loan to pay off the credit card, and immediately all that money that you were giving to interest, now you can hold on to that and use it to pay down debt and or allocate it elsewhere in your company. We want to get to a place that all of your company's profits are not immediately sucked up just by interest payments. That is a debt and death cycle that is incredibly, incredibly difficult to get out of. Another spot where I see debt management becoming an issue is if the entrepreneur has to pay someone off, whether it's an investor, themselves, or let's say a business partner that's leaving the business and they have to pay off. Now that can be painful. Let's say, for example, we need to pay $10,000 a month every single month for 5 months to pay off our past partner the $50,000 that we owe them for their half of the company. On one hand, that is a real pain to be eating $10,000 per month. But on the flip side, there's an end in sight. We know that after the 5th month and the $50,000 gone out the door, that we no longer have that liability. And all of that $10,000 per month that was going out the door, month in and month out, now we get to keep that. And once you've got that extra cash, you can deploy it anywhere that you want in your business, including possibly attacking that debt. Debt isn't necessarily good or bad. Debt is an instrument. It's like a knife. It can protect you and keep you safe, or it can badly, badly injure you. Debt accelerates what's already happening, whether it's good or it's bad. And what you'll typically find is that in an up market, debt can be your best friend because it helps you to invest more heavily into advertising and production. And because the whole market is going up, now you get to capitalize on more and more customers and more sales. Debt, on the other hand, in a down economy, actually accelerates your demise. Debt is your friend on the way up and it's your enemy on the way down. When you've got fewer and fewer customers buying, but you've still got this big debt load that you have to pay interest on every single month, and at some point you do have to pay the principal off, that is a very, very scary situation to be in. So just understand that debt carries tremendous responsibility. I myself have lost hundreds of thousands of dollars, and it was incredibly painful to dig out from underneath that. Doesn't mean that I don't use debt. It just means that I respect it very, very heavily. If you've got a little bit of a cowboy cavalier attitude around debt, I'm worried for you. I encourage you to rein in that bravado a little bit and think about the Warren Buffett 3 question set again. What's the upside? What's the downside? Can I live with the downside?